battling the relentlessly negative doom and gloom news media. It's the Nick Stenger Show, coming to you live from the Stenger Family Office headquarters. It's your host, Nick Stenger.
All right, ladies and gentlemen, welcome back to the Nick Stenger Show. My name's Nick Stenger. We are the Stenger Family Office for the past 43 long years. It's been our mission to deliver both clarity and confidence to help secure your financial future. We're back at it. I don't think we missed any show. Well, we might have missed one, but we're back. We're bigger than ever before. We just had the Wealth Insights Forum in Oak Brook. Packed out room, 130 people. Thank you for coming out. So nice to see you all. And this week we are doing the show a little bit early because we did miss last week. And we are going to be coming to you live in Houston at Trulux. Can't wait to see you. By the time you watch this episode, there's a chance that the event is already passed. If you couldn't come to this year, hopefully you can come next time and come down and see the whole team in the Woodlands. So exciting. We are rolling right through April. It's going to be May. Before you know it, it's going to be Baby Jack's Fiesta Party coming up very soon. And before you know it, after that, we will be getting ready. I looked at the calendar today. Couldn't believe. Going to be doing our mid-year outlook. Hard to believe. Mid-year coming up very soon. And we are well underway into the second quarter of 2024. In a 5.5% pullback. Market went up today on Monday. It's April, and we are watching the market come back just a touch. Who knows what's going to happen here? And I wrote the article this week, episode 148, correction or recession, question mark. That is a question mark. Nobody really knows for sure. And anybody who tells you they know, they really don't know. We're going to see what happens. But all that to say, there's basic things we can do ahead of time that we need to prepare for. In either case, even if the market doesn't decide it's going to be in a correction or a recession, we're just going to get ready and make sure your portfolio is in good shape. I've continued to tell you, be in high quality. Watch out for low quality. Anytime you're going into a volatile environment, you just want to be in high quality stuff. What's quality mean? Well, quality might mean that you have a good balance sheet. It might mean that you've paid down some debt, that you've got lots of cash sitting there. You've got good earnings. And we even call it quality of earnings. Where are your earnings coming from? Are they coming from financing new projects at high leverage loans? Are you getting your earnings from net interest when you're not a bank? That's a big question mark. We do not want to have low quality earnings in an environment like this. We want to have stable earnings. Now, why is the S&P doing as well as it's doing? I believe it's because the market still thinks there's rate cuts coming. And if we don't get those rate cuts, there's a good chance the market could correct. Are we going to have rate cuts? Well, an environment where we have rate cuts would be an environment where economic growth is slowing down. We're having declining GDP. And you're thinking, Nick, I had my Econ 101 course, and I remember that a recession was properly defined as 2 consecutive quarters of declining real GDP. And we did have that in the summer of 2022. We had 2 consecutive quarters of declining real GDP, real meaning inflation adjusted. And nobody ever called it a recession. Why would that be? Is it possible the government is not admitting there was a recession in 2022? And I will say, yes, it is very possible. There is a good chance that the government is trying to hide or fudge the numbers. So I'm not a conspiracy theorist. I'm not telling you that the government does things politically from a political lens when it comes to the economy. But let's just say that it's possible that the government tries to make the government might try to make the president look good if that president is a person they like. So you got to go back to that episode that we did called Your Lying Eyes, and you have to read the data for yourself. You got to be careful before you rely on the authorities for all the information. And I'm not telling you to question everything just for the sake of questioning, but what I'm just telling you is look at the information, sit down, see if it makes sense for yourself. One of the things that you might have noticed is during COVID, during 2020 and 2021, the government, the people in power, were saying that inflation was going to be transitory. There was going to be no need to raise interest rates. And all the people that believed them went out and bought long-term bonds. That's what I'm talking about. I'm just saying, watch out for the narrative. Make sure you're looking at hard facts and actual data, because the data is hard to fake. And I'm telling you, I saw it. Summer of 2022, it was a recession. Why do you call it a real decline in GDP? Why do we distinguish between real and nominal? Well, in 2022, nominal GDP, so just GDP before inflation factored in, never went down in the summer. It kept going up, it kept climbing. And so you're thinking, wow, that's pretty good. GDP went up, and nominally we went up a couple percentage points, no big deal. Well, if you adjust for inflation, the number was far different. Why is it important to adjust for inflation? Well, it all goes back to Milton Friedman, that inflation is always and everywhere a monetary phenomenon. Simply put, inflation is too many dollars chasing too few goods. Or in other words, if you print a bunch of money into existence, all those new dollars are worth less. And if you inflate monetary supply by 40%, like we did under these two presidents we've had now, then those dollars are ultimately worth 40% less, and nobody's better off. So that's why we look at inflation adjusted. I'm not making this up. This is in the economic textbooks, inflation adjusted GDP, real GDP, because if everybody is given, everybody has 100 grand and we give everybody 140 grand, get them up to 140. So we print their money by 40%. Nobody actually has 140 grand. We all basically have what we started with. That's what happened during COVID, except for one group of people. And this is what's super important to remember. This is why actual active management, this is why careful due diligence, this is why managing even your own balance sheet is super important, being careful if you're a business owner, because strong companies survive and weak companies go out of business. And if you take on too much leverage, what can happen is these small little moves in interest rates, these small moves with government behavior or policy can literally wipe you out. There are some companies that have thrived the past couple years, the past 4 years. And I'm not saying that's good or that it's not government engineered. We all know that during COVID, small mom and pop shops were closed down and large big box retailers were allowed to stay open. The government picked winners and losers. Same thing with large restaurant chains versus small mom and pop restaurants. But what you have to realize is that not every small mom and pop restaurant went under. Not every small business went under. The ones that took on too much leverage, the ones that were not preparing for a rainy day, are the ones that got hurt the worst. And same thing with the regional banks that have gotten wiped out with the interest rate rise. They took on way too much risk during COVID, and they bought the long-term bonds, and now they're paying the price for it. So that's the difference. There is a difference between companies. There's a difference between how companies are managed and how companies are run. And there's a difference in quality of earnings, and there's difference in balance sheets. Just because two companies are in the same index, even just because we have two energy companies and they look about the same on the surface, they basically do the same stuff when it comes to production of oil and gas. If you actually peel back the hood, look at the earnings, look at the income statement, look at the balance sheets, could be very different. And that's why you got to be careful when you buy companies. So I've encouraged you, just buy quality and watch out for where you're at in the cycle. Now, these 5.5% corrections, 5% pullbacks are very common. Don't be alarmed by them. They happen 4 to 5 times a year, literally each year. So when you have a 5% decline, sometimes what you want to do is buy more. And then, in fact, I actually think that's not a bad idea today. I will say I do think, and this may sound counterintuitive to what I just said a second ago, but I do think we're due for a 10% pullback, and that this 5%er could go down lower before we ultimately make brand new highs. But who knows? And so when you get stocks 5% off, it's a good time to start maybe adding to some of those companies that you've been looking at. I'm not telling you this as investment advice, but some of the biggest companies that have a high beta, meaning if the market goes down 1%, they may go down 2%, a little bit more volatile than the general market. Those are especially the companies you want to have on your watch list, especially if they've got good earnings, if they've got reasonable price to earnings ratios, meaning they're not significantly overvalued. Maybe they had a 100 PE ratio and then they went to 75. Some of these companies now that had a 75 PE ratio are literally trading for 30 or 40 times earnings. They've got really good growth numbers. They're growing 10, 12, 15, 20%. Again, not investment advice, but we at least want to look at them. That's when you rebalance. So I would buy some now, maybe not put all your chips in, but buy some now. If we go down another 5%, you add a little bit later, but you certainly don't panic. And I heard this the other day. Producer Owen was telling me, hey, one of my buddies says the world's coming to an end and he's telling all of our friends to get out of the market. That's the worst possible advice you could ever receive. So before you listen to your friend in the group chat, be careful because your friend is not a financial advisor. He's not incentivized to keep you on a long-term plan. And the market rewards people on long-term plans. The market punishes people who are trying to time and trade. And then all you ever hear about with traders and market timers is the one time they got it right, or the one stock they had that went to went up 10x. You never hear about the 15 times that they lost money or that they mistimed the market and they ended up paying the price. So here's what I would do. Here's my advice in these environments. Market's down 5%, add a little bit. Market goes down another 5%, add a little bit more. Now you just bought stocks on a 10% sale. Those 10% corrections, not as common as the 5%ers, but they still happen about once a year. You get a 10% opportunity every 12 to 14 months. They don't happen that often. So when a 10% correction occurs, and let's say we do end up in a 10% correction, which would take the S&P from about 5,000 today to 4,750, I almost would venture to say, hey, let's do another episode called Bye Bye Baby Part 2, okay? Because that's a pretty good buying opportunity. It's not as good as when we came out with Bye Bye Baby in October of 2023 and the S&P was 4,400 points, but it's pretty good. It's not bad at all. And so that's where I'd say add a little bit more. You're going to see that rotation. You're going to see stocks make a recovery and go on to make brand new all-time highs. So just stay on your plan. Those 20%ers just don't happen that often. You don't see a 10%er turn into a 20% bear market is what that's called. When the market's down 20 or more, then you call it a bear market. And that's very rare, happens about every 6-7 years or so. And then once in a while you get walloped, and that's called a 30%er. It may not last, and we may not be down 30% forever. Very atypical, but a 30%er would be an event like 08 and 09. That was actually down 60%, if you can believe it. If you had $1 million at the beginning of 07, at the bottom of 08, you literally had $400,000 left. So you can imagine how much people were panicking back then. Maybe you lived it. Maybe you were in it. Maybe you were the person that saw $1 million go to 400,000. If you were our client back then, we told you the same thing. Buy, like it's going out of style. Don't sell. Whatever you do, don't sell. That's the worst possible thing. If you're worried about buying more, fine. At least stay on your plan. But the worst possible thing you can do with a stock is sell when you're down. And so you just want to do careful rebalancing, take some profits from the things that have done well, reinvest those profits into the things that have underperformed. And over time, you see that sector rotation. And again, this is not investment advice. I'm not telling you to go do this, disclaimer, but I'm just telling you a conversation I recently had with somebody who said, Nick, why would I go buy utilities right now and put my money into something that's interest rate sensitive? I 100% agree. I completely see the point. Well taken. Thank you for the question. And the question is really saying, Nick, if bonds are paying 5% and utility stocks paying 3.5%, why would investor take on risk to go buy a utility stock at 3.5%? Well, here's how markets work. Markets don't trade on the information today. They trade on information that's coming 6 to 9 months in advance. And if you can take one thing away from the show, if you can remember one thing that I've told you here, and I've been saying this since 2019, so I hope you've been paying attention, markets are a forward-looking indicator of what's to come. I will say it again. Markets are a forward-looking indicator of what's coming, not backward-looking. Okay, so by the time you read about it in Wall Street Journal, it's already too late. It's already happened. Too late. You missed it. Okay, on to the next story. If you think hey, we got news that there's been a war outbreak, or there's been economic recession, or there's been doom and gloom, or something bad has happened, too late to react. The market's already pricing it in ahead of time. So all of the information, because we have the freest and most open financial markets in the United States, total transparency. We have a really good idea what's going on. We're in the digital age, information economy. We've got Twitter even now, which for better or for worse gives you information very quickly. Because of that, Everything's priced in before you can react. Oh, we think company's going to have a bad quarter or a bad year or whatever it might be. Priced in. So you don't get rewarded in the market for obvious things that everybody knows, like the utility trade. You get rewarded for taking risk or for buying the story, being contrarian is what it's called, on ideas that nobody else would want to get into. So it'd be like, for example, in 08 and 09, when all the banks are falling apart and the financial system is crumbling, to go out and buy the financial sector ETF or the financial sector fund. And when you do that, you are making a contrarian bet that banks are going to come back. Sure enough, they did. And in fact, coming out of 08 and 09, banks are one of the best investments. Same thing in 2020 during COVID when oil literally went negative. So think about what that means. Oil companies were paying to hold oil on their balance sheets. That's terrible. That's a bad situation. Doesn't work forever. When that happened and everybody said energy companies are a disaster, nobody's ever going to want to be in the energy market ever again. We don't need oil and gas. We're going to be on solar farms and wind panels forever and hoping the wind blows and we can power our houses. That would have been the time to buy energy stocks. So it's easy to play Monday morning quarterback like I kind of am here and looking backwards, but that's the contrarian play. It's doing what nobody else wants to do in the moment because it's such an uncomfortable move. That's how you make most of your money. And one of the most contrarian, easy plays that you can make as an investor, whether you have 500,000, a million, 2 million, 3 million, whatever you got, 10 million, 20 million, is that when you have the downturn in the market, when you have the decline, what's your first instinct? Your first instinct is the panic, sell, jump ship, get out. You hear the scary R word, recession coming, or whatever it is you're watching on CNBC. And while all the doom and gloomers are saying, hey, come over here and buy gold and silver coins and all this nonsense, and oh, we're going to get you an annuity and that's going to protect you, you're thinking, nope, I remember what Nick said. Stocks are a discounting mechanism. Stocks are a forward-looking indicator of what's to come. So one last time, what are stocks? What is the stock market? A forward-looking indicator of what's coming. So what does that tell you? The good news is priced in early. The bad news is priced in early. You cannot time it. You cannot try and get in and get out. You might get it right on the way out and be perfect on your timing. But here's your problem. You got to get back in. You got to be right twice. And in our experience, very, very hard to do that consistently over time. You're better off taking the Warren Buffett, Charlie Munger approach, which is to buy good companies and hold them for the long run, which has basically been our approach for 43 years. So you should do that too. Now, speaking of Charlie Munger and Warren Buffett, we did have another big time guy on our podcast that we filmed live. I don't know if you can see this or not, but this was from the Wealth Insights Forum at Gibson's. We had a guest on who co-wrote Stocks for the Long Run with Dr. Jeremy Siegel, one of the most legendary guys on Wall Street. This is the book, 6th edition of Stocks for the Long Run. There's Jeremy Schwartz, who is his star student, co-wrote the book with him. Go check the episode out. Incredible. Why? Because Jeremy lays out the case for why you ought to own stocks over time. Why? Because inflation is rampant. And I don't think we're done with inflation. I've told you this for a while. I don't think that we're out of the woods yet. One of the warning signs to investors is the bond market. We are in an inverted yield curve is what it's called. What does that mean? It means a short-term bond, like a 30-day bond or a 1-year bond even, pays a higher degree of interest than a long-term bond. What does that tell you as investors? That means that we're going to have rate cuts in the future. Well, why would we get rate cuts? Because we're going to go into a recession. So for a few years now, I've been writing articles. I've been saying on the show, no recession yet. Everybody said, Nick, we're going to have recession. Just wait, it's coming. I have adjusted my tune. And remember, we're not always bullish. We try to call it how we see it. We try to tell you what we think is coming. For the longest time, we've been very, very bullish. I'm still very bullish long term. I'm just warning you that there are some cracks emerging in the economy. I don't believe that things are as good as people are saying it is, and namely politicians. We know that they do this. We know they try to conceal. They try to get the president elected again. And we know that we need to question the narrative. We need to look at the data. Couple of data points that we're looking at here. iPhone sales are coming way back. Tesla is discounting their product and they're reducing costs. Why? Because they say they need to keep up with declining demand. So you're seeing this all places. We had a little ice cream shop near us here in Naperville called Oberweis, which literally is right down the road from us. About 50 stores went into bankruptcy protection here not too long ago. Shut down a plant. We had a number of restaurants do this. Red Lobster. I told you. I said this. This is no surprise to you. I said this in April of last year. I said layoffs are coming. Bankruptcies are coming. Small caps in particular are at risk. Lower quality is at risk. So again, we try to give you tomorrow's news today here on the show. We try to tell you, hey, be aware of this stuff. Pay down debt. Get your financial house in order. Don't leave it up to chance, because if you do, you could end up like SVB, Silicon Valley Bank, or First Republic that took on too much risk and went under. So think about this logically. If we go into a recession, it's not all horrible and awful. I mean, people are going to lose their jobs. That part's awful. People are going to struggle. That is awful. But there is still tons of cash on the sidelines. There's still tons of cash to absorb the decline in markets if we do get into a recession. And again, I'm not saying this is for sure. I'm just saying it's a risk we need to be aware of. And think about who's going to survive. The large companies will survive. Companies that pay down their debt will survive. Large families, households will survive. And regular old people like you and I will survive if we've done the careful work ahead of time. We haven't exposed ourselves to low quality in our portfolios. We haven't bought companies with 1,500 PE ratios, price to earnings ratios, which is ridiculous. Be careful with that. We bought the right stuff in our 401ks. If you haven't done that, if you haven't rebalanced, give us a call now. Don't wait till it's too late. Give us a call. We can help you rebalance. We can help you get into the right stuff in your 401k plan, because there is a difference between the different funds and they have different exposures. So do that now. And we can also control paying down debt. Do not buy stupid stuff right now. I tell my team this internally: be careful with your spending, because there is a time coming where if you have too much leverage, remember, amplifies return, but it also amplifies loss. So get your debt paid down. Don't have big exposure to debt. Build up a cash reserve. Have some dry powder sitting on the sidelines. So if we do get a little bit bigger of a pullback, you're going to be okay. And also, if you do lose your job, God forbid, you've got enough cash to back you up and keep you going. So you don't have to hit your 401k account during a decline. So there's all these little things we can do ahead of time to just position ourselves well. And then guess what? If we don't have a recession, and I hope I'm wrong, I hope we don't have a recession, you'll be fine. You'll still be okay. You'll make it out alive, and you're not going to get wiped out. Again, markets price things in ahead of time. New highs happen before the recession's over. This is very important to understand because of the way the market works, because it's a forward-looking indicator. The market literally will go on to make new highs before the National Bureau of Economic Research actually declares it a recession. So that's why you have to be really careful and not panic when you start seeing some of those news stories. It'll already be too late. So I just want to end with this and try and explain. I've been doing a lot of research on inflation, trying to figure this out, because I do think inflation is the biggest risk to the markets today. I think inflation is the worst thing possible when it comes to lower and middle income families. This is the hidden tax that they don't tell you about, where, oh yeah, we'll just print the money. We don't ever have to raise your taxes. We'll just create it out of thin air. There's free lunch. Well, there is no free lunch. We know that. We know that everything comes home to roost eventually, and it always catches up with you. So what I want to point out is where we're at in this inflationary cycle. Okay, what's expensive right now? Well, the most expensive thing is labor. We are a services economy. And so the labor market is really what the Fed watches closely. Labor is a huge deal. If you're a services business, maybe you're even a manufacturing company, after you get past your cost of goods sold and you get down to your actual operating costs, labor's got to be your biggest thing. Okay, it's going to be your biggest expense. So labor markets changed during COVID because we did a couple things. One, immigration slowed way down. We need legal immigration. So we don't want illegal immigration. We want legal immigration. That slowed way down during COVID. That hurt the labor market. And then the second thing, oh, by the way, I'll say one other thing about the labor market. Okay. One thing that I think the Democrats and Republicans should come together on is, hey, we got to get qualified people into this country. I can't tell you how many people I run into at these Fortune 500 companies we deal with, very smart PhDs, doctors, researchers. They can't even get into the country. They've been on a waiting list for a year and a half or 2 years. That's so crazy. That's insane. Okay. Okay. It's also insane on the other side that we just let anybody and everybody in and we don't have a border. I mean, that's insane. That you can't have a country unless you have borders. All right. I mean, this, call me crazy, but those two things seem very obvious. Let's get people in who are qualified, who can take our country to the next level and innovate and grow and build businesses and create wealth. Duh. Obviously, we want that. Okay. And we also got to have a border. I don't understand how we can't just say it like it is and get those two sides working together on those two items. It's insane. Okay. Anyways, I'll leave that there. But then the other problem is we had a lot of baby boomers retire during COVID early. And that's a problem also. We had a lot of people who got a boost in their 401k. They maybe had $1 million and now they have $1.5 million. And then they're finding out that now the money supply is catching up with them. And that $1.5 million is basically worth $1 million again. Remember, real GDP matters, not nominal. And so you're going to see some of these baby boomers come back to the market. I really believe that. I think you're starting to see it already. I think you're starting to see people re-enter the labor force that maybe dropped out. That's good because we need to get labor under control. The restaurants can't keep raising their prices 20%. People just aren't going to go anymore. And then the restaurants will go bankrupt. That's what's happened with Red Lobster. That's what's happened with Oberweis. You know, people aren't going to pay $12 for a milkshake. Ain't going to pay $25 or $27 for a Five Guys burger and fries. That's nuts. Okay. Make a burger at home for $3 or $4, and people will start shifting to that when they start feeling the inflationary pinch. So labor is a big deal. The Fed's watching labor. But here's the problem. The Fed keeps interest rates too high for too long, and they start to raise small business financing costs too much, or they slow down people who don't finance things like our business. We're debt free. We don't have any debt. We're not going to take any debt to expand. We're going to do it slowly and surely and organic growth without debt. Companies like us just are going to be more cautious as they expand. And I talk to business owners all the time. There's basically two camps. There's the ones who have debt and are worried about financing. That's a problem. And then there's the ones like us who are being cautious and working through things slowly and waiting to see what happens before they go all out here. And because of that, what you're going to see is a massive slowdown. It could be on a lag. It usually is. Could be on a lag of 12 months. And so by the time the Fed actually does something and cut rates, it's too late. You're already going to have 3 or 4% lower GDP growth. That's a recession. And I don't think it's a severe recession. I don't think it's an all-out 08 and 09 style collapse. I don't think it's anything like that. But it is going to be a pullback. And I'm going to make the early call here that the Fed's going to get it wrong, just like they did on the front end. They got inflation wrong on the front side of things, called it transitory. And I think they're looking at the wrong metrics. They're looking at the wrong data points. And I think they're too high now. I think if you listen to Dr. Siegel here, Stocks for the Long Run, he just got all fired up on CNBC. We played the video on the podcast. Go watch that podcast, Jeremy Schwartz. It's episode 16 of Bullish. It's the same place you find this show on Spotify, Apple, and YouTube. And we played a video from Dr. Siegel, got Jeremy Schwartz's reaction. The fact is the Fed is already too high at 5.25 or 5.5% in interest rates. They really should be kind of careful here. They might want to get it back down to 3.25, maybe 3% even, because that's the rate of inflation. So labor's a big problem, and then housing's a big problem because housing is a third of CPI of basically consumer inflation. And so those two things are what the Fed is watching more than anything. And if you watch Wisdom Tree's metric of what they use, their adjustment to the CPI rate or PCE, personal consumption expenditures, they would tell you that inflation is a lot lower than the Fed thinks it is. And so remember, if the Fed cuts late, remember what happened on the front end, massive run up in inflation, increase in the money supply. Milton Friedman said, if you decrease the money supply, what could happen? Well, it triggers recession. So that's what we're following. I would not get bearish on stocks because of that. So don't hear me wrong. I'm not telling you to panic. I'm not telling you to sell all your equities. I'm not telling you to run for the hills. I'm just telling you go into the cycle owning quality. And then when you come out of the cycle and let's say we end with a recession and we come out of it, it's a short-lived, hopefully, and people are relatively okay at the end of it, then hopefully then we can kind of reassess where things are at, and we might be able to go into maybe a couple small caps that are doing okay. That's when we might look at a few other things. But I just think it's way too early. I think it's way too soon, especially on the bond side. I think you're way too early to add duration. You're getting paid 5.25%, 5.5% of floating rate treasuries to sit there and do nothing with no risk. I don't see a reason to go take risk right now, especially on the part of the portfolio that's supposed to be a ballast against the doom and gloom. So that's where we're at. All I'm telling you is we're not on a Boeing plane where the door is going to fly off. Okay, you're not sitting in the exit row of one of these planes that was badly put together at Boeing recently, and you got to hold on for dear life. I'm not saying that at all. All I'm telling you is it's like a pilot coming over the PA system. Ladies and gentlemen, have a little turbulence here. Put your seatbelt on. Buckle up, just so you know you can't get up and go to the bathroom. We're not going to be doing beverage service here for a few minutes, and we're going to land. We're not going to collapse. We're not going to crash into the ground. Door's not going to fly off, but we're due for a little turbulence. So just be prepared for that. I hope I'm wrong. We're going to invest like we're wrong, as if we're still in the market, and we're going to still be in stocks, but we're just going to be in high quality. We'll get through this. It's going to be fine long term. We're going to be seeing new highs in the S&P, I believe, in the next 3 to 5 years, but we are due, I believe, for some turbulence short term. So stay on your plan, stay the course. If you haven't rebalanced, that's the biggest thing. A lot of your money might be tied up in your 401k at work, so you got to get that thing fixed. Get it right now. Don't wait for the turbulence to happen. Thanks so much for being with us. This was episode 148. We'll see you next week for episode 149. Thank you so much.